Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Planning. With this week's video, I was off last week due to the 4th of July holiday. I hope you guys had yourself a fantastic holiday. So we have a lot to cover here in this video. We're going to be taking a look at the four major U.S. indexes. We're going to be talking about the results for the first half of the year through June and what that often means in specific sectors moving forward based on the first half of the year's performance. We're going to be taking a look at breadth. We're also going to be taking a look at what analysts are doing for expectations moving into this next earnings season and what that could mean for the overall market. And we will certainly talk about what the Fed has done here. But where I want to start is actually on a little psychology, a little big round number theory. There's a theory out there, basically, when you break a big, large, round number, that you continue to drift and follow through in that direction. And it's something you'll see a lot if, stock's trading at, let's say $98 a share, and it closes over that $100 mark, that big, round number. You typically tend to see it continue to push forward and grind higher there for a little bit after that. That's that big, round number theory. And the indexes themselves are all around key big numbers at this point in time. The S&P 500, that 3,000 level. So you would expect we close over this 3,000 level, that we would continue to drift higher in that direction here, at least for a little bit, due to that large number theory. The Dow is right there at 27,000. Close over 27,000. Again, same comments apply. We would expect to see a kind of grind higher above that 27,000 level. The Nasdaq broke over the 7,900 level. I think 8,000 is a better psychological number. A close over that 8,000 level, which we're very close to at this point in time, would also lead to that kind of grind higher. And the Russell 1,600 is that big psychological round number that's over there. Now, take a look at those four major U.S. indexes. We got new highs that were just put in on the S&P 500. We've had new highs that were put in on the Dow. We've had new highs that are put in on the Nasdaq. Here we can take again a look at the Russell, and again at this point in time, we're still well off of those highs. We're almost 12% below those highs at this point. And what people will continue to talk about here is the potential for this being that kind of head and shoulders top. Now, again, I've mentioned it before. In order for a head and shoulders top to be confirmed, you actually need to break the neckline. So you would actually need to move below 1450. So there's a lot that would have to happen before this is actually confirmed. But the fact that we have the mid caps 12% underneath all-time highs, so the other indexes are trading at all-time highs, is quite the divergence. One of the two things is going to happen. We're going to see the mid and small caps finally catch a bid and catch up to those indexes here, or the indexes themselves, may see, kind of a pullback towards the Russell. As it sits right now, with strength out of finally, all three of the indexes, the Dow making that new high, the S&P, and the Nasdaq. Money is certainly flowing into tech, which is that risk-on environment. So I would think that the three indexes would probably be a better indicator of where things are going than the one, just the Russell. But it is certainly something that we do have to continue to pay attention to. One of the things we always like to talk about is breadth. Here's the Nasdaq. The McClellan Summation Index we talk about, and I have mentioned this a number of times, when you get that crossover here, it means you have a tailwind, all right? When you have the cross under, you have a headwind in the market. So tailwind, headwind, tailwind, headwind, tailwind. And once again, so, we have the backdrop for a potential to continue to push higher due to that breadth ratio reading, which is something we certainly pay attention to. If we were to see that cross back under again, then we might be concerned. But as it sits right now, we got three of the four major indexes at all-time highs. We had the best first half of the year, one of the best first halves of the year, and the best June since 1955. So the market certainly has been extremely strong as of late. Now, let's take a look at individual sectors' performance for the first half of the year and correlation to where we might go based on past performance. All right, with correlation as close to the results as we've had this year, there is a total of 6 years in each of these groups. But what you will see is through June, the average return through June in out of this sector You know, the S&P up 18%, staples 17, discretionary 29, you know, so on and so forth. Average return for the rest of the year is about a third of that number for how far we've gone through June, with a little bit of rocky performances in there. But you can see almost every single one of those continued to see gains except for healthcare, which was basically averaged flat. When the market behaved the way, as close as it's behaved to the first half of the year here. So this is, you know, another good piece of information here for the bulls. When you have such a strong first half of the year, you know, you're not expecting the S&P, you know, to finish the year up 40%, but you would expect, again, about a third of a gain of the original gain throughout the rest of the year based on past performance. And of course, you know, that doesn't necessarily mean that is what's going to happen in the future, but that is another data point that does show positivity for the bulls. Now, another interesting potential positive for the bulls is actually how bearish the Wall Street analysts essentially have gotten. They have continued to revise earnings lower and lower and lower. All right, only September 2017 had more pessimistic analysts in the past 3 years. Well, let's go back and let's look at the market, what happened in 2017 in September. So let's take a look at the S&P 500. We'll come back in here to September. I'm going to clear all the drawings out here for you guys. All right, so here we are in September, going into that earnings season with extremely pessimistic analysts. Right? Look what happens. We get a really big rise into the end of the year. Now, why is that? Well, if expectations are extremely low, which is, you know, what has happened here over the past couple of months, you know, analysts have continued to lower their expectations. Markets pay attention to what those analysts think, right? It's much easier to beat, you know, negative or revised down estimates than it is lofty ones. So usually when you go into an earnings season with expectations being really, really high, there's an extra level of risk because a slight miss can oftentimes lead to some decent sized corrections because the market is expecting phenomenal things. Well, here we are, the market's at all-time highs. We're going into earnings season, and, you know, recessionary fears are all over the place. And we're going to talk about what the Fed, you know, may do here at the end of this month in just a second. But expectations are extremely low. So any sort of beats, any sort of raises in guidance, etc., could really give fuel to the fire for this market to really kind of push things higher. And if earnings are not that great, that's kind of what the market's expecting, so it might not have a huge negative impact for us. And so that's why when we're taking a look at those numbers, we go back to other times where we have been, you know, had that many revisions down, right? We oftentimes will see, you know, good rises out of it. So heading into this earnings season, I think it's really important. Unless earnings are just way off the mark, I think that's kind of that catalyst that really could lead us higher here through the rest of the year. Now, let's talk about the Fed. Trump has made numerous comments towards Powell that he, you know, wants the rate hikes to stop and actually would like, you know, rates to decrease. If we did that, you know, it would supercharge the economy and the market would rock and roll higher. And has been putting a lot of pressure on Powell to cut rates. Yesterday, the Fed minutes came out, and it looks like on the table for the end of this month is actually a potential rate cut here. Now, when we talk about rate cuts, if we don't actually go into a recession, the first rate cut in a bull market, if we do not go into an actual recession, sees the stock market go up in the past since 1971 100% of the time. Now, the first rate cut and the market and the economy actually goes into a recession, stocks are only positive 20% of the time. So if we get a rate cut here, and we go into this earnings season, and earnings are not doom and gloom, we're headed into a recession, that would certainly give fuel to the fire and should, based on, again, what's happened in the past, give us a very good likelihood of the markets continuing higher here through the rest of the year. So where we're sitting right now is a very interesting spot. We're at all-time highs. We're talking about the Fed cutting rates here, so to help the market out. Expectations are extremely low going into earnings season. We've got the potential here to really see some explosive moves into the second half of the year if the actual economy itself does not head into a recession. I think that we have a very strong potential to close the year higher than we are right now. So we are going to continue to pay attention to all of those economic data points because they are really, really important at this point in time. If we do continue to see some of these negative economic prints that we've talked a lot about here in these past videos, that could mean that maybe the Fed was a little bit too late to cut rates, and we might have some rocky roads ahead for us. But as long as the economic data prints are going to be okay, if the Fed is going to backdrop this market and lift it up by cutting rates, we've got ourselves a potential for a solid end of the year. I hope this video was helpful. As always, I hope you guys have yourself a fantastic week. I will see you guys next week. Take care.